Welcome to this Killick Explains Finance video. This week, the very basic bones of trusts. Now, start with quite an amusing quote. Put not your trust in money, but put your money in trust. So said Oliver Wendell Holmes, US physician and author. And in certain circumstances, trusts can be very useful. I'm going to look at two main types, the basic players and how they might be used. Now, the basic benefits of trust. They are a way to hold property on behalf of other people, a so-called beneficiary. More about that in a moment. So a great way, potentially, to hold property on behalf of children and or grandchildren. Number two, they can be a way to reduce inheritance tax, so they can reduce what's called the death estate of the person putting the assets into trust. Thirdly, it can be a way to protect assets. This can be a good way to protect assets in the event of, say, divorce or bankruptcy proceedings. So it gives you a degree of third-party protection, if you like, for the assets that are in trust. And it can be a way to manage assets on behalf of somebody who can't. I mean, a trust could be set up for a child that's not yet been born, for example. So, who are the key players? Now, with all trusts, there are three key players, and there's quite a lot of choice, depending on the type of trust you set up, about who these players are. You have a settlor. Now, a settlor is the person who puts assets into trust. Those assets could be property, investments, and so on. They're called the settlor. And they can also be one of the trustees. Now, trustees look after the trust property while the trust deed is in existence. And that's a legal document that specifies how the trust assets to be managed. As I say, there's no problem with a parent, for example, being both settlor and trustee. That's quite a common arrangement, but the trustee could also be another family member, it could be an advisor, and so on. And then you've got a beneficiary who's going to benefit ultimately from the assets. And they can benefit in a couple of ways. They may get some benefit while the trust is in existence, income generated by the asset, for example, and or a benefit at the end when the assets pass from the trust to the person who is going to benefit. Now, key distinction. And this drives the type of trust that's set up in practice. If you've got a fixed beneficiary, a named beneficiary, a grandchild, for example, then typically a bare or absolute trust will do. They're relatively straightforward, the tax treatment's relatively straightforward, and so on. If it's more complicated, usually flexible beneficiaries, unborn children, children with different requirements, and or a spouse and children, so you want some benefit to go to a spouse, some benefit to go to children, then much more likely you'll need what's called an interest in possession or discretionary trust. That is not all the types of trusts that are out there, that gives you the main division between them. Now, a bare trust, how would this work? Well, for example, it could be grandparents are the settlors, they pass an asset into trust, property, investments, could be any of those things. Trustee can be any other family member. It could be one of the grandparents, but bear in mind you want a trustee who presumably is going to outlive the grandparents, and or a family advisor. So it could be an accountant, solicitor, and so on. And then you've got a named grandchild. Remember I said a fixed beneficiary. So in this example, a named grandchild who's the ultimate beneficiary and will take control of the assets in the trust eventually. Now, key features. This is a solution, as I say, perhaps to somebody looking to fund university education for a grandchild. The amount paid in can fall outside the estate of the grandparents, which is quite neat. Income and capital gains are levied at the child's marginal rate, taking account of their allowances. So again, that can be quite neat potentially. And finally, something to bear in mind with these trusts, the child is absolutely entitled to the trust assets aged 18. And there is no possibility of advancing those assets other than for certain specified purposes. But that could solve the problem, as I say, of a grandparent wanting to fund, say, cost of university. Now, discretionary trust, the players are the same, but the mechanism is slightly different. So you've got, in this example, parents perhaps as the settlor, passing assets, investments for argument's sake, into a trust. You've got a trustee. Now, they can be a trustee, so can a family advisor or another family member. And then you've got a trust deed specifying who is going to benefit and when. And chances are it'll be a slightly more complicated arrangement. There may be more than one beneficiary and they may benefit in different ways. Now, key features can be set up so that income is paid to the beneficiary as it arises. So you can have this thing called an interest in possession trust, and that can even allow potentially for, say, your spouse to receive the income from an asset, a property, for example, and then somebody else, maybe children, to ultimately take control of the property. Secondly, you may be able to lend the trust capital. That can be quite a useful way to draw capital out of the trust and potentially ring fence it in the event of, say, divorce or bankruptcy. Income tax is levied on the trustees usually, that's just a summary of the tax treatment, subject to the normal tax-free allowances. The taxation of these trusts is complex, so definitely don't just take this slide as all the guidance that you need. And the beneficiary becomes entitled as the trustee basically specified. All right, and there may be scope to advance capital earlier at the discretion, hence the name discretionary trust, of the trustees. Now, quite a bit of ground covered there, lots of detail left out, but there's a basic tour of the two types of trust and how they might be used. Any questions? editor@killick.com, and to see related videos, killickexplains.com.